All right. Good evening, everybody. How are you guys doing? Hold on, check. Okay, so you guys, if you can hear me and if you can see me clearly, just click yes on the comment section so that I know that you are able to hear me. Welcome, everybody. Welcome to tonight's session brought to you by Bursa Malaysia-𝑖, and we're gonna talk about how you make your money work for you passively by investing in bonds or Sukuk. Right. So for those who are interested in investing in a Sharia compliant bond, then we have an exchange traded bonds and Sukuk, which is listed in Bursa Malaysia, where you can take advantage of. All right, we'll wait for you. We wait for you guys coming. Thank you, Patrick. Thank you, Ahmad Badri. Thank you, Arul. Hi, Jatinder. Hi, Muhammad Saiful. Welcome. Okay, so basically what we're going to talk about today is about bonds, right? And how you can invest in bonds by learning how to look at the price and also yield for bonds, all right? And of course, if you are expecting a returns like the stock market, then this is, you won't get that kind of returns, right? This is basically a very low risk investment asset class. And of course, it is probably slightly better than fixed deposits. I think right now it's probably better than fixed deposits because the rates for fixed deposits are really low, right? And if you are to invest in bonds, what kind of returns that you'll be expecting, and also, what kind of yield that you'll be getting from the bonds, all right? Okay, just let me check for a while. Some of you guys say that the image is a little bit blurry. Well, you guys, well, I'm still preparing to make sure that everything is in proper order. Please do share this session if if you find that this will benefit any of your friends who are interested in bonds. Basically, I'm not a bond expert, but I did a study, of course, and this is one of the most basic investment asset class that most actually investors learn. All right. But of course, the reason why it is not well received is because you have alternatives like trading in bonds, trading in stocks, right, where you require higher returns. But this will be good for someone who wants to have at least a return which is consistent, something that you would expect, and very low risk. All right. So at least when market falls, these are investment asset classes, that can actually hold your portfolio, now including like REITs and ETFs and so on. But of course, in terms of returns and risk, stocks will be the highest priority, the highest list, right, where the risk is high but returns are also high. But so it depends on the categories of stocks as well, right? And then of course you have the REITs and you have the ETFs, which come in second, and then we probably have bonds, all right, and then probably FDs and so on. So I'm just going to share my screen right now. Okay, I think we can start. Hold on. Okay, I checked. My internet seems to be very strong. Okay, you know what, guys? I think I'm just gonna go for a while. I'll come in back in a short while. Just let me go and restart this thing. Okay, can you hear me, guys? Wait, let me fix this image first. Maybe fix the video first. All right, I hope this is better. Okay, let me check for a while before I start, because you guys need to look at the presentation slides, and it has to be clear. If not, you won't get clear images. Okay, awesome. Now let's start. Yeah. Okay, so the title of this webinar tonight is called "Make Money Work Harder for You Passively," right? Without managing it, and of course, you basically need to know what bonds are all about and how to calculate it and how to actually buy bonds. And of course, this is the Sharia compliant way, meaning that we are talking about exchange traded bonds or sukuks. All right. Um, so basically, the way it works is exactly as the same as a bond, but rest assured, for those um, uh, who wants to invest in Sharia compliant bonds, this will be a asset class that you can look at. All right. Okay. Nice. Okay, welcome guys. Once again, those who join us, who just join us, welcome to our investment workshop. This is basically brought to you by Bursa Malaysia-𝑖, and we had to run a series of workshops in the past few weeks. Right, so you can actually look at the recorded videos we are normally on Wednesdays for Sharia compliant investments. Right, so we have started from the very beginning about what is Sharia investment compliant. We talk about stocks and so on. And this is the 6th episode, right? We have one more episode coming up, and that's how to build a stock portfolio in the Sharia compliant or Sharia compliant stock investment portfolio, and how to start with. All right, but today, because we're going to talk about bonds, right? It's one of the asset class that is also listed on Bursa Malaysia, where you can invest and trade just like any other stocks. All right, but of course, the performance and the risk, it will not be the same as stocks. So that's the reason why we want to explain to you what it's all about. All right. So first of all, whatever that is being mentioned here today and discussed here today is not intended as an investment advice. It's just basically for informational and educational purposes only. All right. So should you look for a investment advice, please look for a professional and licensed investment advisor. All right. And guys, if you have any questions at all, you can just type in the comment section. Then I can try to answer. Now, I'm not really a real expert in bonds, but I just basically sharing with you what I understand, and hopefully that, especially when it comes to the calculation part. So the second part of this presentation is going to be a little bit heavy, So I mean, if you guys are okay for a cup of coffee, maybe you want to get a cup of coffee. All right. So then type in any questions that you want, then I'll try to answer them once I finish my presentation. All right. So basically, how would you like to make money to grow, make your money grow passively without managing it and expect guaranteed returns, right? It's the same thing like putting your money into fixed deposits, right? Where you don't need to worry about managing it. Your money will continue to grow based on the rates that you'll be getting, right? But of course, we want better returns than fixed deposits. We are not working hard enough, and our money is not working hard enough. Okay. I'll show you later on. I'll give you some figures or some data. What are the rates currently, right? What are the expected returns? What are the risk-free rates, and so on and so forth. and including inflation rate, right? All of this has to be taken into account to make sure that your money is well preserved. All right. Now, so this is basically an instrument which is low risk in nature, all right, especially if it's issued by governments. All right. So there are two kinds of bonds which I'm going to share with you in a short while. All right. Companies can issue bonds, and government can also issue bonds. All right. Bonds is like a long-term debt. All right. So that means if you buy a bond, you are lending money to the issuer. So if a company, let's say, wants extra additional money to grow the company and he don't want to go and dilute the shares or give up more shares, then he can go to bonds, all right? Instead of lending or borrowing money from the banks, because sometimes borrowing money from the banks, the interest rates are much higher. So bonds could be one of the ways to raise funds. See, companies can do that. Governments also can do that, all right? So investor basically will receive dividends or interest, all right, or we call it coupon payment. It's normally expressed in percentage of the principal amount. So let's say a corporate bond that comes out and says, you know what, I need this money, you can buy this bond, and I'm going to give you a 4% coupon rate. That means whatever amount that you're investing, you'll be getting a 4% interest annually. All right. So what are the differences in bonds and shares? Number one, bond is a fixed income security, whereas shares is an equity security. So the difference is the bond holder is an owner of the bond asset, okay, the bond, the paper, right? But it doesn't have the rights to ownership of the company. Whereas if you buy shares, you are a shareholder of company, right? You have rights in the company. Now you have steady flow of payments as coupon. Now, every year is sometimes there are different kind of interest that's being paid or coupon that is being paid. Right? There's fixed one. There is a there's a fixed one. There's a variable one, and so on, which I'm going to share with you in a short while. All right. So it's steady flow, especially if you get a fixed rate coupon. That means every year, if let's say it's a fixed rate coupon of 4%, every year you are guaranteed to get 4%. All right. Dividend payments for shares, you get dividends, right? So that depends on the company's dividend policy and also the performance of the company, right? Bonds are less volatile, right? Because the dividends is quite fixed, right? So there's not much volatility, right? But there is certain factors that affect bond prices. Later I'm going to share with you as well, right? Shares, of course, impacted by market volatility and different forces, right? I think we are more familiar with shares. Okay, bonds has a time limit or it's a maturity. That means at one point of time, until it matures, the bond will expire and you no longer own the bond, right? Basically, the issuer give back your money, all right? So that is after the maturity. Shares does not have a maturity, of course, unless the company go delisted, then you can't invest in a company anymore, all right? So government can issue bond, corporates can also issue bonds. So governments want to borrow money to build infrastructure, finance projects and initiatives. And if they don't have enough in the coffers, they come up with bonds. All right. So there are many different bonds actually issued by government, okay, which you can actually purchase them over the counter by some banks. Okay. So later I'm going to explain to you also what's the difference between over the counter bonds and also exchange traded bonds. All right. Corporates also can borrow bonds. All right, I can issue bonds so that they can borrow money to maintain and also grow their businesses. So exchange traded bonds are basically fixed income securities, also known as bond or sukuk. All right, sukuk is the Arabic word, of course, for a Shariah compliant bond. All right, so they are listed and traded on the stock exchange. Okay, so normally if you're going to go and buy bond, where do you go to, right? Of course, you can go to the banks unless you want to buy, a certain amount or large amount of money, then only they probably want to give it to you. If not, it's not easy to actually buy bonds over the counter. Okay, so exchange traded bonds, I think if you have followed us and go through the REITs, and ETFs, okay, where it's actually a hybrid between REITs, between mutual funds and stock market. This is like a hybrid between bonds, okay, and the stock market. All right, so they are listed on traded on the stock exchange, so you can buy and sell these bonds. All right, we call it ETBs, right? Exchange traded bonds and sukuk. You can buy and sell them like any other shares in the stock market. All right, so the prices are quoted on the exchange. You can see the prices. Minimum trading size is 10 units, typically with an IPO price of 100 ringgit. Thus minimum price would be 1,000 ringgit. So the lot size, the price is 100 ringgit. Okay, or the ETBS that is currently available in Bursa Malaysia, I'm still going to share with you later. All right. So over the counter is a little bit different because this is traded, you buy them or sell them over the counter in the banks. Okay, after you initially buy them, so you need to contact them for the prices because they don't issue the prices. It's not as transparent as you can see, like you can see in the stock market, right? So of course, banks will set the terms and conditions for buying and selling those bonds as well. Okay, so sometimes the cost can also be quite high if you go through buying bonds through the banks. Okay, so ETBS is something which is more it's more easier for any retail investor to buy and sell, okay, because it's just like buying and selling any other stock. Okay, so these are some of the common types of fixed income securities or bonds. They're different kind of coupon that they pay. One is called a fixed rate bond. Okay, this is like a plain vanilla, a very simple fixed rate bond, where you there's no options attached. Right? It's just I'm gonna issue this bond for let's say I raise 100 million ringgit, and I'm gonna pay 4% every year. So every year you get 4%, 4%, 4%. And let's say the maturity is 4 years, right? It's gonna mature in 4 years time. Then of course after 4 years, after paying 4% dividend, after 4 years I still need to pay back that dividend, that principal, the face value that I mentioned in the prospectus, right? So I'll mention to you how much I'm going to sell a unit to you, and then how much I'm going to buy back from you at a face value. Okay, so you get 4% every year, and at the end of that bond period, when it's matured, then you get back your principal as well. All right. Now, so a fixed rate bond behave in market, okay, because fixed bonds are very, very, affected by interest rates. Okay, I'm just going to share with you later why, right? What's it? Why is it so? Because interest rates do play an important role in determining the bond prices. So if it's a fixed rate bond, so no matter what, right? If interest rates go down or go up, it doesn't matter where the interest rate go because it's not fixed to any interest rates. The price of that bond normally will not go that much or not go far. All right, so price normally just stay stagnant. All right. Floating rate bonds are based on a interest rate. All right. I'm not going to show how it's being calculated, but basically you get, for normally in Malaysia, they will use the CLIBOR or the Kuala Lumpur interbank offered rate, all right, to determine what's the rate that they're going to give for that particular bond. So it's not fixed like 4% every year like we've seen earlier. All right. So if let's say the interest rate is down or the CLIBOR is low, then you get lower dividends. If the interest rate, if the CLIBOR is high, then you get higher dividends. So it fluctuates year on year. And of course, once it's matured, you'll also get back your principal, right? At the end of when the bond matures. All right. Now the third, so floating bond, of course, is affected. The prices of a floating rate bonds are affected by interest rate, right? So normally when interest rate come down, the price of the bond normally comes down as well, right? Or the coupon rate or the interest rate comes down because it's affected by the CLIBOR, all right, or the interest rate. Okay, so the coupon rate, the dividend that you receive from your bonds depends on the interest rates on CLIBOR, and of course CLIBOR also is very much affected by the OPR rate, okay, or the Bank Negara's overnight policy rate or interest rate. Okay, so of course, if it's a floating rate bond, then it will move according with the changes in interest rates. All right. So the difference between fixed rate and floating rate bonds, not fixed rate. Okay, typo error over there. So the fixed rate bonds, you get a fixed coupon rate. That means the dividends or the profit sharing is the same every year, all right? Whereas a floating rate bond, you get variable coupon rate depending on the interest rate that is being referenced. Okay, like in Malaysia, mostly use the CLIBOR. Okay, there is no ceiling or caps or floor caps for fixed rate bonds, but bonds with floating rate may have come with a ceiling or floor. in which the floating shares cannot exceed or fall below a certain interest value respectively, all right, because that to avoid volatility. Now, coupon payments normally are being paid every 6 months for fixed rate bonds. All right, that means semi-annually, 1 year twice. Okay, coupon rates for floating rate bonds may be frequent, as monthly or even every 3 months. Okay, so it depends on the issuer, lah. All right. Fixed rate bonds are generally issued by governments and government-backed entities because they are fixed, right? And normally, government bonds would be lower than corporate bonds because corporate bonds may be deemed as riskier, right? Because I mean, what happens if, let's say, the person cannot pay you back? Because remember, when you're buying a bond, you're lending them money, they are borrowing your money. So what happens if they can't pay you back, right? That's a question. So government generally will be able to pay back unless unless something happen, okay. But corporations, yes, corporations can go, let's say, can go bankrupt, can cease the operations, and then you will not be able to get back your bonds. Yeah. Of course, there are also different kind of bonds. For corporate bonds, they also have guaranteed bonds, okay, even government-backed bonds, and so on. So you have to look at the prospectus of a corporate bond to know your risk. All right. Zero coupon bonds are basically bonds that you do not get any coupon. That means you don't get dividends, you don't get profit sharing every year. Okay, but what happened is, let's say you have a zero coupon rate with a 3-year maturity with a 1,000 ringgit value. But what happens is that right now the issuer will sell it at a discounted price. All right, maybe now it sells at, you can buy now at 700, but after 3 years you will get back 1,000 ringgit. All right, so you can calculate how much of returns that you get last is like, over the 3-year period or over the 5-year period. Okay, this is just an example. Okay, but basically a zero coupon rate is where you don't have any dividends or you don't have any coupon payments or profit sharing. All right. Hybrid bonds are convertible bonds. This allows bondholder to surrender his bond in exchange for a specific number of shares from the issuer, and normally this is from corporates lah. All right. So they can, of course, these are the common ones. There are many different bonds available as well. So if you go and read the bond market, you can see there are I don't know, there are quite a number of bonds lah. All right. That I think you probably heard about toxic bonds and so on and so forth during the 2008 financial crisis, right? So in the US, of course, there's even much more. All right. But these are the 4 most common ones. But today we're going to talk about fixed income bonds. Okay, because the ETBS that is currently available, there are only 3 of them, and it is being issued by Dana Infra, which is government owned. All right. Now, what are the expected returns for ETBS? Okay. So there are 2 factors to consider when you look at returns. One is the price, all right, and the other one is basically the yield. Okay. I hope that one was just the beginning of the intro. I'm just going to focus more on this part here because this is the more important part. All right. So these are the factors to consider. One is the price, whether it's at the premium, whether it's at a discount, or whether it's at par. Okay, I'll explain that in a short while. Right. And of course, the yield, which is actually the income return on an investment or your investment, normally is calculated in annual percentage from your investment cost. All right. Whether it's from your current market value or its face value. So we're going to talk about price first, all right? Then we're going to talk about yield. Okay, so when do price becomes higher and when price goes lower, or when it's equal to, let's say, the price of the face value and the current market price, all right? Now, if let's say your coupon rate is higher than the interest, the normal interest, and that's we call it the ongoing interest or the risk-free interest. Okay, for example, let's say if your interest is 3%, okay, let's say FD, FD is almost like a risk-free interest rate, right? Let's say your FD is 3%, okay, and your coupon rate is 4%, right? That means you're actually getting more than FDs. So what's going to happen? Normally, the price will be higher than its nominal or face or par value. All right. For example, let's say when you bought initially was 100 ringgit, okay, and now it's probably at 102 or 103 ringgit because you are buying it at a premium, a higher price. Because right now the interest rate that you'll be receiving, or the dividend or the coupons that you'll be receiving, is higher than, let's say, you put your money into FDs. All right. Now, of course, if your coupon rate, your dividend is lower than FDs or interest, then your prices will come down. So interest rate is very important, right? So if, let's say, if FD is 5%, but your coupon rate is only 4%, then of course the demand for that bond will be lower, prices come down. All right. If the coupon rate is the same, okay, or dividend is the same, and the interest rate is the same like the FD, then you will see price will just remain stagnant, or you'll be on par with the face value. Okay, so interest rate plays a very, very important role in bonds. All right. So this is one example. Okay, I'm gonna basically share with you. This is one of the bonds that's being issued. All right. This is Dana Infra. This is a 10-year bond from 2013. Okay. So there are three bonds issued by Dana Infra, which I'm going to share with you roughly in a short while. But you can get more information from bursamalaysia.com. All right. And bear in mind that these are all Sharia compliant. This is actually an Islamic bond, so it is Sharia compliant bond. Okay. So this particular bond started in 2013. Okay, and you see from 2013, early 2013, the price was going up, but because the interest rates were going up, all right, this is basically OPR, central bank or Bank Negara's OPR. We go to 3%. If it's 3% OPR, of course, your FD will normally be a little bit more higher than the OPR. All right, so it can be like 3.5%, 3.6%. So if, let's say, if it's 3%, or let's say even 4%, right, that's given out in FDs, then it's the same as the the bonds. All right, so that's the reason why you see bond prices fell in 2013 to 2014. Okay, and then in 2015 it started to go up again. All right, because 2015, 16 until 2019, the bond rate seems to be fixed. And of course, in the past 1 year, it has accelerated. It has gone up even more because interest rate came down. All right. So interest rate comes down, and you can see that this price, this bond, the par value was 100 ringgit, right? And today it is trading trading at around 103 or 103. So that means it's 3 ringgit higher than the par price, or the par, or the face value. All right. Okay, so how do we determine the price of a bond? Okay, first of all, just to get the basics right, there are two different kinds of, or two types of pricing on the bond price. The first one is called a clean price, which is the current price. All right, so if you look at the market, for example, if you look at that bond that we looked at earlier, it is at 103. That means the basic price is at 103, or the clean price at 103. Okay, the dirty price of a bond includes accrued coupon or dividend amount since the last coupon or dividend rate. Now, what happened is this: normally a bond price, if let's say it is not affected by any other factors, right? A bond price generally will start to go higher towards its maturity because you'll be receiving more dividends. And of course, this assumes that interest rate is probably the same or it's lower, all right? So the moment it starts to give out coupons, the price will start to pull back a little bit because you get the returns, right? You get back your interest or dividends. Same like share prices, right? The moment you get dividends, the share price came down to adjust the dividend. Okay, so bond prices do adjust its dividend as well. But you know what? If it still continues to, over time, if let's say the other factors are all fixed, the price will generally come back up again. And then when they give dividend, it comes down again. So normally prices move like a jigsaw or seesaw. All right. But this is assuming that all factors are fixed. Okay? In the market, of course, there are many other factors that affect prices of bond, like interest rate I just mentioned. Okay. So what's a dirty price? So a dirty price is basically the basic price or the clean price plus the accrued coupon. All right, because that means you have to look at when was the last coupon or dividend being paid, right? And then if you are looking at after 1 month or 2 months after being paid, you have to take that 1 or 2 months as an additional. all right, on accrued dividend, because that was because you are up to current date. Okay, so for example, if you want to sell right now, you can sell based on the clean price. Just look at the market price and clean price, or you can look at it with a accrued interest, because if you keep on holding your bond, if let's say this bond is being paid out every 6 months, okay, after 6 months you should be receiving, let's say if it's 4% annual compound coupon rate, then you receive 2% every 6 months. So you forgo that 6 months if you sell now. All right, you forgo that 2% if you sell now. Of course, you when you sell now, you take if you sell somewhere in between that 6 month period, let's say 1 month after the payment, then you use that 1 month to calculate what's the price, right, which is being factored into the current price. Okay, I know it's a little bit difficult to understand, but you may get some idea. Let me show you some calculation. All right, so let's say the coupon or the clean price is 90 ringgit right now is 1 month, and now is 1 month after the coupon payout. Okay, so let's say the coupon is being paid out in June. Now it's July, right? So now it's July. So this is July price, right? In 90, and let's say the coupon rate is 12 ringgit every year. Okay, paid every 6 months. That means your accrued dividend is, you take 6 ringgit, okay, because you divide by 6, right? Because it's paid every 6 months, and the last payment was in June, so you get an additional 1 month. So 1 out of 6 months from a 6 ringgit, that means you have actually accumulated 1 ringgit, right? If you were to hold it until the next 6 months, until let's say next one is January payment, then you could have received that 6 ringgit, right? But because you sell now, right, you forgo that 6 ringgit. But because right now you sell on the 7th month, or the the 1 month after that payment, then you just include that 1 ringgit into your price. All right, so the dirty price is basically your clean price plus your accrued dividends. That means it's 91 ringgit. So although the price is at 90 ringgit, okay, but the real price, okay, or the dirty price is 91 ringgit. So if you sell it to the market right now at 90 ringgit, that means you're missing out that 1 ringgit, okay, because it's already 1 month. If of course after 6 months, then your price or your dividend, you should receive an additional 6 ringgit dividend. All right, so that's the basic concept of clean price and dirty price. The reason why I share with you this is because later I'll show you where you can do the calculation. Nowadays you don't need to do the calculation yourself manually. There are websites that you can go to calculate bonds and also to calculate yields. All right, now one of the method that normally being used to calculate the price of bond is using a present value calculation. All right, so for those who know about present value, you're going to investments in investing, if you to calculate returns, most of the time we calculate present value or future value. All right, because you have to remember that if you receive a 5, make it easier lah. Okay, if you receive, let's say, a 50 ringgit dividend right now, the current value right now is 50 ringgit, but in 1 year's time, that 50 ringgit you're going to receive in 1 year's time, the value may not be the same with the current value, because remember there's inflation and so on. So that 50 ringgit future value may be only 40 ringgit or 40 plus ringgit. Okay, the further it goes, because we know that the time value of money, right? Over time, the value of money gets lower and lower and lower because of inflation and other factors. All right, so that's why we're going to receive this in the future, right? So we need to calculate in the future what is the value like presently. Okay, so this is why we use the present value calculation. So here, for example, the chart here, if you receive for first 0 right now, you get if you get 50 ringgit, of course you get 50, right? But over time, that 1,000, let's say that you receive over here is not 1,000. You will receive 1,000, that the value is 1,000 in the future, but the present value, okay, based on a 5% interest, okay, that means this, let's say inflation is 5%. Okay, based on the 5% interest, that value that you're going to receive 1,000 is only valued 950 today. All right, the longer it is, the longer it is, the less value it is. All right, so if you really add all them up, okay, because you anticipate that this is going to be until 5 years, you're going to receive, let's say, the coupon payment or the dividends or the profit sharing for the next 5 years. Okay, although it looks like, okay, you receive 1,000, 1,000, 1,000, 1,000, it's like you receive every year 1,000. So you add all them up, it's actually 5,000 ringgit, right? So you do receive 5,000 ringgit, but because the value falls, the money value falls over time. So if you do this calculation with a 5% interest, okay, or that 5% can be inflation, then we are looking at the present value. Okay, although you receive 5,000 ringgit, but that time the value will probably be only 4,300. All right. So that's a present value method. So this is the calculation, and like I said, um, right now I'll just give you some reference or some website you can calculate those price for you easily. All right, but this is just basically for those who want to know how it's being calculated. So basically, this is the calculation for present value with an ordinary annuity. That means you receive a fixed rate all the time. Okay, if you receive a if your coupons are different, then the calculation will be different. It's going to be a little bit harder. All right, or even let's say the interest rates are not fixed. Okay, your expected interest rate is not fixed, then it's going to be different calculation as well. Okay, so what is the expected interest rate? That one we need to know. And normally we use inflation rate. Okay, if not, we have to use a reference, and the easiest is also basically fixed deposits, because fixed deposit is like a no risk investment, right? You put your money there, you still get money. Yeah, put the money in the bank over, let's say, a period of 6 months, 3 months, or 12 years, you get the money without any risk at all. All right, so that's a risk-free rate. You can use inflation rate, or you just have an expectation, right? But if the expectation too high, of course, then you will not expect to buy bonds, right? Because your expectation is too high. But if your expectation is low, and you have to use the right expectation on the interest, then only you get a better calculation. So later you see, you can actually calculate based on current price what kind of interest rate are the market expecting. All right. So from this calculation here, you see you get that 4329, which was the calculation here, right? So instead of doing this manually, you can use this formula over here to get that calculation. Okay. So in this case, the coupon or the cash flow you receive, like here in this example, is 1,000 every year. The interest rate is 5%. All right. The number of payments is how many times lah? Okay, let's say 5 years, then it's 5. Okay. So how do we calculate bond price? Okay, so the present value of bond price is the sum of all coupons in present value, which was the previous calculation, plus the present value at maturity. That means the amount that you receive back, right? At the end of the or the bond period on the maturity date, if let's say it's 1,000, but it's in 5 years time, right? So 1,000 in 5 years time, the value is not, the present value in 5 years time is not 1,000 anymore. It's going to be lower, and that's the reason why you see the M here, the present the value at maturity. Okay, it uses the present value calculation as well. All right, so you add all them up, and then that's where you should be able to get your bond price. Yeah, I'll just show you an example later on. Okay, you can go back and do the pricing yourself. So bond price is this formula. Okay, so here you actually get a bond calculator or bond pricing calculator. You can use this on a website. Is you can take a snapshot right now if you want to, or you can just go and go to the website right now, or you can also go and download the slides later. All right, so I share with you how you can download the slides. So this is basically the formula to calculate the price of bond right now, the present value, okay, based on a present value calculation method. Okay. Now, these are the 3 exchange traded bonds of Sukuk that's being issued by Dana Infra National. Okay, this is of course government owned. So there are 3 of them. Okay. So if you look at the first one here, and the first one is issued on the 8th of February 2013, the profit rate is 4%. That means you're receiving 4%, right? And the value or the face value is 100 ringgit. That means basically you get 4 ringgit for every 100 ringgit that you invest in 1 year. All right. So the issue date is 2013, and since this is a 10-year Sukuk, all right, a 10-year bond, then the maturity date will be on the 8th of February 2023. Okay, so for this particular bond, they pay in January and July. All right, so twice a year. Then a few months later, on the 31st of October in 2013, all right, they issued another bond, okay, which is a 15-year bond. All right, so this one ends on the 31st of October 2018. Okay, value is the same. The profit rate is also 4%. Okay, also 4%. I forgot to put here, but it's 4%. This one gives you April and October dividend payment, profit payment. Okay, and then we have a 7-year bond or Sukuk, okay, which was launched in August 2014. Okay, so that means this is going to expire in 2021 July, which is 1 more year. All right, so to know what are these bonds for, all right, just go to bursamalaysia.com, or you can just search for these bonds. You should be able to see the details on what this money is being used for. All right, so these are basically government projects like MRT and so on and so forth. Yeah. So if you buy these bonds, that means you also have actually lent money to the government to build the MRT. All right. Okay, this bond here gives you a profit rate of 4.23%. Okay, the one with the 7-year exchange, the last one over there. So basically, there are 3 different bonds, exchange traded bonds that you can invest in. Okay, so 4%, 4%, 4.23%. I'm just going to share with you, this is the price of the bond. This is the price of the first bond, 0400 GA. The name is so long, so I always remember by the stock code only. Okay, so we have 0400 GA, GB, GC. All right, so GA is a 10-year one, started in 2013. GB is a 15-year one, 2013. And GC is a 7-year one that started in 2014. All right. Okay, so how do we calculate, right? Right now, the current price is 103. That means, you are actually, if you buy at current price, you are buying it at a premium. Now, why is it a premium, right? Why is it a premium? Why is it higher than the face value of 100 ringgit? Okay, so it gives you a 4% profit rate. That means you still receive 4%, regardless of what price you buy. Okay, you get 4% profit rate. Okay, in Sukuk we call it profit rate. They don't call it dividends or coupon rate. They call it the profit rate. Okay, so if let's say you buy 100 ringgit worth of this Sukuk, okay, every year you receive 4 ringgit. Okay, not 40 ringgit. Sorry, let me just adjust this again. Okay, that the 40 ringgit is based if you bought 1,000 ringgit worth lah. All right. Okay, so now when we want to calculate the future or the present value of the rates that you'll be receiving, that means every year you'll be receiving 4 ringgit, 4 ringgit, 4 ringgit, 4 ringgit. All right. So this one, the years to maturity is only 2 years left. Remember, because this one, this Sukuk is going to end in when is it going to end? February 2023. So 2.5 years. All right, so I'm just going to put here 2 years. So in 2.5 years, this is going to be matured. All right, so it's going to pay you 4%. Okay, so every year in the next 2 years, you're going to receive 4 ringgit, 4 ringgit if you invest only 100 ringgit. But of course, in 2 years' time, that 4 ringgit that you receive may not be the present value. All right, so we use that to calculate the present value and see what kind of price. So question is 103 a price that you can buy? All right, because we do not want to buy if the price is too a premium, right? It's too high, or better if it's par value, or if it's better if it's slightly at the discount. All right, but normally if the interest rates are very low, okay, like say the policy rates are very low, you will not get bond prices coming down very low, they will go higher. All right, because you get better rates by putting your money in FDs. Okay, so I'll give you later some examples. So these are some of the examples. I put some reference over there. Okay, Here, the required rate that I'm going to put in, that means the rate that the money is going to depreciate in value over the years is 3% per annum. All right, 3%. Why 3% is because if you look at the bank base rate is between 2.8% to 3%. Okay, if you look at FD rates today, it's only 1.85 to 2%, maximum also 2% or 1.95%. Right, that's FD rates for banks. Okay, so that means if you put your money into banks right now, you only get 2%. But if you put and you buy, let's say this Sukuk, a bond at 100 ringgit, you at least you still get 4%. All right, 2 times better than your FD rates. Okay. So that's why the price goes up, right? Because at 103, your yield, all right, your dividend yield will not, or your bond yield will not be 4% anymore. It's going to be 3 plus, right? Because 4 ringgit over 103, not over 100 anymore. If you buy at current price, okay. But of course, if you buy this at below 100, when you start buying it, and you start buying and you start to accumulate this, and your average price is below 100, then your bond yield will be higher. All right. So imagine if it's, let's say, 95 ringgit is your average price. No, 95 is too low, the lowest. Okay, maybe 98, right? 98 is 2% from 100. So even if it's 98 ringgit, your average price, you manage to get your bond at 98 cents or 98 ringgit, right? And you get 4% or 4 ringgit every year. Okay, so your dividend will be much higher than 4%. Okay, it's probably like 5+%. Okay, so if you look at this, the required rate, I'm going to put in as 3% to calculate the present value. Okay, the bank base rate is to, okay, I mentioned the fixed FD rate is only 1.85%. Okay, years to maturity, 2 years. Okay, so if I'm going to do this calculation, like I said, just go to this website, it will do a calculation for you. So the bond par value is 100 ringgit because that's when the maturity date, they're going to pay you back 100 ringgit only. Even if the price, if you bought it at 105, they're going to pay you back 100 ringgit. If you bought it at 120, they're going to pay you back 100 ringgit. All right, because over the years you have probably received back your dividends, your profit rate, okay, which is much more than the capital loss. So annual coupon rate is 4%. Remember, the market or discount rate I'm looking at to calculate the present value is 3%. Years to maturity, 2%. 2 years. Day since last payout. This is to basically, if you still remember, to calculate the clean and also dirty price. All right. So this is 6 days after it's being paid up, because this particular bond paid out their profit rate on the 23rd of July. So now it's 29th of July. So it's already been 6 days. All right. So if you look at the dirty price, is 101.99 or 102 ringgit. Okay, that's the price it should be. Okay, based on your expectation. Of course, if you put your market rate or discount rate higher, then your expectation to buy for this particular bond will be lower price. All right. So 102. So basically, the bond price today, based on present value calculation, is 102, right? But the current market price is 103. That means there's a 1 ringgit premium, all right, which is 1%. Okay. So of course, if let's say interest rates go lower, then this would be better alternative, isn't it, as compared to putting your money into FDs. Like I said, FDs currently paying only 1.9 to 1.95%. Okay, so maybe I can show you that link later on. Okay, so you can use this same method to calculate the other two bond prices. All right. Now I'm just going to go through fast also. This is yield, right? So what is a yield? Yield is basically your returns, all right, that you'll be getting the moment you receive your dividends, the returns over your investment. All right. So what's the relationship between price and yield? So the yield is basically the interest that you receive over your price. So in other words, if the price goes up, like now, if the price is higher, your yield is lower. All right. If the price is down, your yield is higher. Okay. So there are two ways to measure yield. First, number one is the current yield. Okay. Number two is the yield to maturity. Okay. This is the true return that a bondholder receives if a bond is held until maturity. Okay. And interest payments are reinvested as the yield to maturity date. All right. So you basically hold this until it matures, then you get back your returns from the dividends, and also of course there's also another returns from if there is a capital gain. All right, so a current yield is a very straightforward yield calculation, right? So you look at the annual dollar interest paid divided by market price times 100%, right? So let's say we take a look at the first example again, the 0040 GA. The current price is 103, right? The coupon rate is 4% of 4 ringgit. So you take 4, all right, 4% divide, you use this calculation, right? So 4% of 100 ringgit is basically 4 ringgit, right? So 4 ringgit divide by 103, okay, you'll get 3.88%. So if you buy at current price, your current yield is 3.88%. Okay. Now, because the current yield calculation does not include the capital gain or loss, all right, because remember, if you buy this at 103 right now, you buy at 103, right? In 2 years time, you sell it back, it's going to be at 100 ringgit. So that means you're going to lose 3 ringgit. All right, if you bought this bond at 98 ringgit, then at least when you sell it 100 ringgit, there's a capital gain of 2 ringgit. All right, so this one here, you will have a capital loss of 3 ringgit. So the 3.88% yield that you'll be receiving is just the yield. But remember, if there is a capital loss, you have to include the capital loss as well. All right, so this is the calculation, right? So here is the annual coupon over the market price, like the one we calculated earlier. Okay, and this one will be the capital gain or loss. All right, the first calculation is the one that we calculated earlier. This one will be the capital gain or loss. So like in this case, you do the calculation here. Remember, it was 3.88%. Okay, that's your current yield calculation, right? But you take the loss that you're going to incur, okay, 105, 100 divided by 103, which is 1.5. Okay, then you just minus it off. Okay, then you get that current yield. Okay, because remember, you receive 4 ringgit, but you divide by, you have to minus that 8 ringgit with the 2 ringgit, the 3 ringgit loss, all right, over the 2 years period. So that's why your yield goes low. It's now actually 2.38%. All right. Okay. Now the other one is to calculate the yield to maturity, which I just explained. That means you hold it until you, until it matures, right? What kind of returns that you be expecting, right? So this is an approximate yield to maturity calculation. In other words, it's like a simple method to calculate it, but of course, it's not as of course, it's more complicated than this, because when you use the present value again of all the coupon payments and put it in, then you have to calculate one by one. It's going to get a little bit more complicated, right? But this is simple manner. Okay, so if let's say I use a simple yield to maturity calculation, right? So you just follow the calculation, maybe 4%. Okay, so you do this, you divide this, you get 1.66%. Okay, but this is not a true year yield to maturity calculation. This is just an estimate or approximate, right? To calculate, again, you can go to this website, okay, this bond yield to maturity calculator. This will give you a better, a more precise calculation, because this one, it uses the present value, whereas the earlier calculation, it does not use a present value. But that's just to do a fast calculation. But like I said, you just have to go to internet, go to this website and put the figures there, and you get the calculation. All right. So you look at the current bond trading price is 103. Okay. The bond face of par value is 100. Years to maturity, you have another 2 more years. Your annual coupon rate is 4%, and it's being paid twice a year. All right. So remember, if you look at the bottom part here, you see that's the current yield, okay, is 3.88%, which we calculated earlier, right? But your yield to maturity is 2.454%. Okay, remember, because we're also looking at this includes the capital gains as well, or loss. In this case, it's a loss. So if you look at the earlier calculation, this is approximate, it's 1.66%, so it's so much lower. But when you calculate the yield to maturity using the real calculation, using present values, you get 2.45%. That means your yield is 2.45%. Let's say if you buy at the current price, okay, the yield that you're going to receive on an annual basis over the 2-year period is 2.45%. Okay. So you have to ask yourself the question: is the price right? Okay, at 103, is it right? Because you buy at 103, when you do a present value calculation, it should be 102. Then your expected returns, your expected interest, that 3% interest, will be enough, right? Because if your expected returns is higher than 3%, when I say 4% or 5%, then your bond price will go down to 98, 97% if you expect high returns. But you have to remember, you have to be realistic and follow the real interest rate, or the ongoing interest rate, right, or the inflation rate, or the risk-free rate, right? You cannot put too high, because this is to substitute that. What if I don't buy this bond, right, and I put my money into FDs? Okay, so if you measure against FD, which is 2%, the price is definitely much more attractive. All right, but I put 3% to allow. I'm using the bank rates. If you search the Malaysian risk-free interest rate on Google, you should also be able to see what's the risk-free interest rate. All right. So you can do the rest of the calculation. I hope that this will give you an idea basically what bonds are all about. Okay, and this is a Sukuk, right, which is a Sharia compliant bond which is traded on Bursa Malaysia. Okay, so if you are looking for investment, in this case, if you look at the current yield, it provides you about 2.38%. If you look at the yield to maturity, is 2.545% at current price. Right? So if you buy at, if let's say the price is at 100 ringgit, it's going to be very difficult for the price to come out to 100 ringgit lah, right? But if it does go to 100 ringgit, if you buy 100 ringgit, then lucky you get a 4% interest rate. All right. So of course, people anticipate, right? What's the reason why people do not buy when the prices were trading at 97, 96 ringgit? The reason why there are not many people buying bonds at 96, 97 ringgit, because the interest rate at that time was high. All right, so that's why this bond is not attractive. They use that money to maybe just put in FDs, because you put in FDs, you probably get more than 4%, or even let's say equal to 4%. It is still more attractive than bond, right? Because FD is deemed as like zero risk. All right, but bond still has certain risk, but this is a government-based bond, so for me, this is almost zero risk as well. All right. Okay, so I'm going to answer your questions. I'll take about maybe 10 minutes if you guys have questions lah. All right. So I hope that today's presentation will give you an idea about bonds and how we use bond price calculations and how to calculate yield to know whether that particular bond is worth investing or not. All right. Most important thing in bond, that's why for a lot of bond holders, for a lot of people who buy bonds or invest in bonds, interest rates is a major factor. All right. So they always look forward to interest rates. All right, because when interest rates comes down, then people will start to accumulate, or the demand for bonds will start to increase. All right. So if you guys are interested to know more about Bursa Malaysia-𝑖 and its products and services that they offer, just go to Bursa Malaysia-𝑖 on their Facebook, on their Twitter, and also on their Instagram. Okay, and if you want to download the slides, same, you just go to this particular link or website for you to get today's slides. All right, once you have filled up, give us about 1 week, probably to get everyone to fill up the evaluation form. Then we will send you those slides. All right. Okay. Thank you, guys. So now let's take a look at your questions. I hope not many questions also lah. Christopher, wait Christopher, you're asking, is the coupon same as dividend? Yes, it is same. Like it is like a dividend, but of course it's not called a dividend. It's called a coupon because dividend is normally from shares, right? Coupon is from bonds. Buy 100 and get 40, buy 100 get 4. Buy 1,000 get 40. Okay, so I made that I already made that correction. Okay, is there a bond tracker? What kind of bond tracker? You don't really need to track bonds, because you can. So the thing about ETBS or exchange traded bonds, the chart that I show you, if you have an online broking account or any other accounts, if you have a charting, you can actually plot the chart, okay, of price of bonds. So you can actually track those price on Bursa Malaysia, and that's the beauty about this, right? Because if you go to an over-the-counter price, it's basically difficult to get that price information, and it's very difficult to track. But in Bursa Malaysia, is because it's listed in Bursa Malaysia, you actually get the prices, the historical prices, and you can plot it on the chart. All right. When do we sell the bond as it is traded on the regular exchange? Do banks charge the same value for transaction fee? Right. So banks will have their own terms and conditions. All right. When they want to buy or sell the bonds, okay, they have commission, they have sales charge, they have they have other fees, and of course when you sell back also you have to look at their rates. Right. They are the one who set the rates. Okay. Because banks make money, I mean, from these transactions as well, lah. Right. So that's why the transaction cost is a bit higher. But if you buy on Bursa Malaysia, it is same like buying stocks. You just pay the commission, right? And of course, the spread between the buy and sell, because one of the things about bonds is the liquidity is not as high, right? If you look at ETF, for example, it's almost the same like ETF, not much being traded, but you will get market makers. All right. So if you have time tomorrow, you go and check. You look at the quote screen, right? The buy and sell. There's always a buy and sell quote. All right. And if you want to buy a lot, you can. Let's say in the volume, if you really want to buy a lot, then you can always arrange with your broker to do to find a buyer or a seller for you. All right. The bond price increase isn't much based on your example. The bond price doesn't move much, right? You see, even for that particular bond, the lowest was about 90, slightly below 96. All right. And then the highest right now is 103 lah. Okay, so right now is the highest price. Okay, so it's not much, because you have to remember that bonds are basically not like stocks, right? Most investors invest in bonds because they are more interested in that passive income, and it's a fixed passive income. As long as it is better than FDs, right, then I will probably want to invest in bonds. If it's not as attractive as FDs, if let's say FD is paying 5%, then this 4% bond will not be interesting. Even if let's say the FD pays 4%, okay, I will not find this interesting as well. Okay, it has to give me higher yield than the bank FDs. That's why price comes down. So when price comes down, remember, if let's say the price comes down to 94 or 96 or 97 ringgit, and you buy at 97 ringgit and you get 4% coupon rate, 4% annual dividend or coupons, your yield will not be 4%. Your yield become like 5 or 6%. All right. So which is better than the 4%. So it always tracks. Normally it tracks the interest rates. All right. And normally it's higher than FD. Right. Because if it's not higher than FD, then it's not going to be interesting. There's not going to be demand. All right. So when you hold until maturity, of course, along the way you get back your dividends. After the maturity, you will get back your money in face value. For example, if that nominal value on the first GA or the first Dana Infrastructure bond or Sukuk, right, you get 100 ringgit back. So if you invest, let's say 1,000 ringgit at 100 ringgit, okay, then you get back 100 ringgit, you get back 1,000 ringgit. But if you buy at the price now, because the price right now is 103, right? So you buy 103, when it matures, you only get back 100 ringgit. You lose that 3 ringgit. All right. So that's why you have to take account into the capital gain and losses as well. All right. The reason why it's trading at a premium right now, because the yields or the coupon rate right now is attractive. All right. But if you calculate based on the current yield, it's only about 2.6%. Okay, this is yield to maturity, and it includes the capital loss. Okay, that means, so although you buy at 103 right now and you sell it at 100 right after it matures, okay, you buy 103 right now, sell it when it matures at 100 ringgit, then you lose 3 ringgit, but because you receive that 4 ringgit, right, every year you receive 7 ringgit, so you take the 7 minus 3, net off, you still make 4 ringgit. All right, so 8 ringgit minus 3, you net off, you still make 5 ringgit. So 5 ringgit from 103 is about 2.6%. All right. Bursa will make any announcements. You can go to Bursa Market bursamalaysia.com, and you just go to bonds and you can see the bonds there, right? So currently there are 3 bonds. Not many people issue. There are many bonds, all right, that's available in banks and so on and so forth. But for not many go through the exchange traded ones, all right. So this is why this is interesting, because this is an exchange traded bond, right, where you can get access easily. Yeah. So I mean, bonds, there are plenty of them, right? So can we use a trading platform directly ourselves? The coupon interest will be banked in, like, yes, correct. All right. So you can actually buy and sell bonds, like exchange traded bonds, are not bonds, exchange traded bonds, like these 3 bonds that I just mentioned to you, just like any other stocks. All right. Okay. So yeah, I guess I've answered all your questions. No problem, Christopher. This is why we are here for, right? Make sure you understand, at least understand the concept of bonds, right? Which is totally different from other, like stocks that we also use, is totally different from ETFs. It's totally different from REITs, because they are higher risk, but they also have higher expected returns. This is more like you know, no matter what price you buy, if you are satisfied with the 4%, 4% based on the nominal value lah, right? Like in this case, you buy every 100 ringgit or 103 ringgit, you get 4%, right? 4%, 4 ringgit, 4 ringgit, 4 ringgit. If you buy, let's say, 1,000 units or worth 1,000 ringgit, then you get 40 ringgit, 40 ringgit every year. If you buy 100,000, then you get, of course, 4,000 a year. All right. So these are for those who wants a fixed return. And you notice as well, over the past 10 years, 15 years, the price does not fluctuate that much. On the chart, it looks like a lot, right? But when you look at terms of percentage movement, it's normally 2-3%. Okay, and that 2-3% is because it is affected by the interest rate. Okay, and we know that the Bank Negara don't raise interest rate like 1%, 2%. They always go like 0.25%, 0.5%. So that's why the fluctuation is not much. All right. Aside from price and interest, does the company issuing the bonds be relevant to the decision of whether to buy a bond or not? Yes. So you need to know who the issuers are. I think that's what you are asking, right? Does is relevant to the decision of whether to buy. Yeah, you want to buy a bond, like for example, these bonds are all government project. It's used for government projects. It's guaranteed and backed by government, right? So it's almost zero risk. Okay, almost zero risk. Like, it doesn't matter, right? Whether whatever political party, because this is actually government, not political party fund, right? But companies, you have to be very be careful a little bit. You need to know whether that risk or that bond is being backed by assets. There are some which are backed by assets. There are some which are not. All right, which are normally called like debentures, right? Which are not backed by assets. Some of them are even backed by government security, government. So you really have to look at the prospectus. And of course, debentures and those who bonds which are not asset backed will normally give you a higher coupon rate, because risk is a little bit higher as well. All right. All right, guys. Thank you for joining us. I hope that today's session will be enlightening to you as it is for me. Okay. In fact, I know about bonds and all that, but only recently, because I have to actually present this, I have to look at these 3 bonds, right? And it is quite interesting, right? So if you are looking for something that is, instead of putting your money into FDs, right? Why not bonds? All right, because this is still safe and you still get better rates right now than the 2% that you'll be receiving, okay, from fixed deposits. All right. So guys, thank you very much for joining us, and I'll see you again in our next session. Actually, for Bursa Malaysia-𝑖, next week we're going to have one more session, and it's going to be the last session, and it's going to be basically building a Sharia compliant stock portfolio. So don't miss this. We're going to talk about that, and I'm probably going to have Alvin with us as well, because he's the one who he's good at value investing and picking investing for stock portfolio. All right. So good night, and I wish you all the best. All right. So if you have any questions, you can type it down, and I hope that we are able to answer your questions down there as well. Okay.